Silver is going to make you very wealthy on its own. This is anti-dollar trades. We coined the phrase anti-fiat. Gold is the king of anti-fiat. Silver is the queen. Gold gets stored and bullionized, and jewelry can be recycled. The queen gets consumed and is in shortfall. Gold has a turbocharge on it because of the debt fiat debasement, and it holds value. But the queen has a twin turbo. The recycling brings some of it back, but some of it is at these prices not worth it. There's a deficit to supply. Silver is the queen. Queen actually gets consumed and has a physical delivery issue. Gold can be recycled, and there's a lot of it stored in bullion. We're getting a turbo on top of a turbo. Gold is the turbo and the king of the turbo. Silver is the twin turbo because it's got the production shortage to the consumption.
According to market strategist Francis Hunt, the real wealth transfer of this decade lies in anti-fiat assets, with gold and silver leading the charge. Gold remains the king of anti-fiat, benefiting from global debt expansion, fiat currency debasement, and its role as a recycled store of value. Silver, however, is the queen with a twin turbo. Unlike gold, silver is heavily consumed in industrial applications, creating persistent supply deficits and physical delivery pressure. While some silver is recycled, much is lost forever at uneconomic prices. This unique combination of monetary demand and real-world consumption positions silver as a potentially explosive anti-dollar trade. Now, we present the clips from Francis Hunt's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
When you had sort of Wall Street silver chase, and it's all small retailers all taking leverage and buying and hitting the stack, what you have is a speculator with leverage-based boom. And the way you kill a speculator with leverage-based boom is you're up margin. So the main mover of the market is the speculator who's been given too much leverage or has managed to get access to any amount of leverage, and you make that leverage more expensive, less available, and much more capital down. You do those three things. It's the same as house price. If you have to put more money down, the interest rates are going higher, which we're predicting, by the way, with the debt-based collapse. You can afford to pay less. You can't chase for that house, and prices come down because everybody else that's relying on a mortgage is in the same boat as you. That's how you cull and take the knees of a speculative with leverage, retail-driven market. Now you've got to ask, is this market that market? A retail speculator with leverage markets? No, you and I might be doing that, but we're the sideshow. We're ants. This is major industry physically demanded market. So what's different about that, and what is the net effect of that? Well, what happens is when you increase margin, the way the futures market work is the buyer has to put more margin down and might pay more interest for the lesser margin that he gets to run in and whale in. But the same applies to sellers who do sellers contracts. You might say, okay, but why is that a problem? That means they're less selling. No, the mines sell in the futures market, and it goes up by day, the cost as well. So the longer they're in, the more it costs them to hedge, and they sell forward production. So when you increase the cost of them forward selling their production, and by duration as well, they say, well, we'll hold off a little longer. We're saving some money by not forward selling, and the price in the market is pretty good, as you can imagine. So they then don't bring it as soon, and they don't do it for as long, and it reduces supply of producers, which is the miners, making available because you push their costs. Remember, they have an accountant and a treasury that will be looking at this and go, they made it more expensive for us to go there and sell it. And we sell it and we hold the contract until, for 3 months. Why don't we just wait till the last week? You've saved a bunch of money by doing that. You've saved a bunch of money. And they're the ones that bring big contracts. You and I might buy one contract which has 5 by 1,000 industrial bars. Most retail, not buying 1,000-ounce industrial bars, by the way, in the futures market. I have, but most retail, 10 ounces, 100 ounces, maybe you get 100-ounce, from Scottsdale, and it's a nice little brick. People aren't buying the ugliest sin industrial use market. So it's not retail that's actually pushing the futures price up. And if you make the cost higher, people will be more tight and delay offering that contract. So what actually happens is you're killing the offer stack. There's a bid stack. There's the midpoint where the trade is taking place and it's flickering along, a little bit up, a little bit down. And there's all the offer stack. At that price, I'm happy to sell my forward production. Remember, markets are used not just for speculators. There's the commodity, the business interests, the operators. Now, I'm trying to remember what the phrase is. I'm having a bit of a brain fart, but the industrials, it's the commercials, they call it, when you get the breakdown on retail, commercial, speculators, etc. The miners are the commercial. So they'll choose more selectively. And given the price market, they also don't need to rush. So why should they pay more to rush to do what for a long time, just to hit a rate when it's already deep in the money and possibly going deeper? They're in greed mode now, and they can hold off. So what it actually does is it reduces the offer stack. And then those that are squeezed and in a suppressed situation, think UBS, as if the story is true. We don't know. There's rumor, there's everything. We've always suspected certain banks are going to be hit, American ones, European ones. They now have to chase much higher to get a certain number of contracts closed. So they have to bid more aggressively. And that's why you're getting the parabola move. And you've got that 60-year of suppression all having to be made right very, very quickly. And you've gone and made it worse. You've poured fuel on the fire by making it expensive for suppliers. Remember, it's not being driven by retail guys with leverage. We're not it. It's being driven by lack of supply and real delivery. The markets have turned real delivery. Where you previously used to have low percentages of delivery and it was all speculate and cash market, you're now having 60% being marked for delivery. That changes the game. It makes it a real market, and that's when you start to get real prices.
This market is no longer driven by leveraged retail speculation. As explained in this analysis, raising margin requirements does not crush silver prices. It kills the offer stack. Higher margin and financing costs discourage miners, the true commercials, from forward-selling production. By delaying hedging, producers reduce near-term supply into futures markets. At the same time, banks and large players facing real physical delivery obligations must bid aggressively to close contracts. With delivery rates surging towards 60%, silver has shifted from a paper-driven market to a real delivery market, unleashing suppressed prices and accelerating a historic breakout. Let's get back to the interview.
This is anti-dollar trades. We coined the phrase anti-fiat. Gold is the king of anti-fiat. Silver is the queen. Gold gets stored and bullionized, and jewelry can be recycled. But the queen gets consumed and is in shortfall. So gold has a turbocharge on it because of the debt fiat debasement, and it holds value. But the queen has a twin turbo because it's also getting consumed. The recycling brings some of it back, but some of it is at these prices not worth it. And there's a deficit to supply. It's a complicated formula. I have done it, but you have to add in. I would add all the. If you wanted to do it perfectly, you would add M2, India, China, Europe, UK, US, and you wouldn't have all of them, but you would have G8 nations, and you put them all in brackets. Then you get an even bigger and better idea of total money proliferate. Whilst the US is the biggest proliferator in percentage and absolute terms, the others haven't done that badly either, as you can imagine. And that only just boosts that. Can I also say I'm getting a reputation now, and I'm being named as the silver messiah because our YouTube channel has just been, it's all about silver from before this happened, and we've just been bang, 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 precious metals, all of any catchword, I'm out there and I'm talking about it. And one thing I will say is we're probably the most bullish, and on your chart that you showed there, my assessment is we surpass that substantially. Wow. Not even slightly. Inflation is basically the excess issuance of money. Zero issuance of money, zero inflation. It's simple as that. But anyway, that taken. So you haven't even got to the 2011 high, and there's people already calling tops that don't realize it. You haven't got, if you throw up the gold silver ratio, we haven't got to even 30, never mind what I expected to run, which would be at minimum single digits. Where are you at there on the gold silver? I can't see the value.
51.85.
You're still north of 50. You're still north of 50. You haven't made 30. Everybody thinks, well, the modern era is now 30, 33, That means nothing. That we are resetting this entire era of financial debt from Federal Reserve era, 1913. This is what's being reset. There's a whole new financial world coming in, and they want digitization, which is funny enough why I mentioned to you the one crypto that has really outperformed is Monero. Everybody wants something physical that they can hold that can't be tracked and traced. And the one crypto that's currently running, which we called utilizing HVF method, is the one that's longest standing and most believable for having some genuine security against privacy invasion. I don't think anything digital is going to be perfect, but this is one of the sincerest attempts.
Anti-dollar or anti-fiat trades are redefining wealth preservation as global money issuance accelerates. Gold remains the king of anti-fiat, thriving on debt-driven currency debasement and its role as a recyclable store of value. Silver, however, is the queen with a twin turbo. Unlike gold, silver is heavily consumed, creating persistent supply deficits that recycling cannot fully replace. With inflation rooted in excess money creation across G8 nations, precious metals are resetting a century-old financial era. As the gold-silver ratio remains historically elevated, silver's upside potential signals a structural repricing in a rapidly changing monetary world. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.